We're going to start here soon. This meeting starts, if anyone's on, it starts at 12 o'clock Eastern. 4 minutes. 4 minutes, 4 minutes, 4 minutes. Meeting starts in 2 minutes. The meeting will start in 2 minutes. We have a webinar, and I've always intended to go live with the webinar to kind of compound efforts. And I always forget. By the time the webinar is over, I'm like, oh man, I forgot to go live. So here we go, live, and the meeting starts in 2 minutes. 2 minutes and counting. And I don't know if any of you have ever done this, but use this as your Zoom camera. So like a good camera as your Zoom camera. Being that I have 2 minutes, I'm going to give it a shot. So let's unplug audio here. Try this. Turn this on. Let's see. Video. And just so you know, you guys are on a live that's going to start in 1 minute. 1 minute, 1 minute, 1 minute. And I'm trying to see if I could use this camera instead of the Zoom camera. I'll have to get back to this. It's so crazy. The phone camera is better than any camera. Even these good cameras. All right, 1 minute, meeting starts, and we're going to be discussing Willow Park opportunity. And I'll take questions from Instagram. I'll try to catch it at a corner of my eye, and the real Zoom, which is right here. Spit some questions. There's nothing more I love than some questions. And I'm trying something else today too. I'm on YouTube, streaming on YouTube. We'll see how it goes. And I'll get back to this. Maybe the next Zoom will have super high def video. All right, testing. We'll take these out. So this is about the stuff that I've posted on Instagram. Right now you have a backstage because I didn't go live on the Zoom yet. This is about the opportunity that I've been posting, or some of the opportunities that I've been posting, this one being a specific one. Multifamily opportunity in Arkansas. So before you say that Arkansas, there's nothing going on, you would be wrong. All right, getting the audio going, and I will get started as soon as I microphone testing. Gonna get an audio guy to come out here. All right, the meeting's gonna start now. Hey, what's up, everybody? Alex, jump on. Let me know if you could hear my audio. Getting started, Instagram. Or someone jump on and let me know if you hear me. You should, because I see the microphone jumping up and down. Don't be shy, Jen. We could hear your voice, but thank you. Awesome. All right, good. So I want to make sure I could hear you. Alex, say something. Or Jen, say something.
Hey, I'm on.
Gotcha. Awesome. Okay, we could get started. I don't want to be in a position where I start talking and no one can hear me. So thanks everyone for jumping on. This is a quick webinar about our opportunity in Fayetteville, Arkansas. I'm so trained to say Fayetteville, North Carolina, because we just closed over 300 units there, but Fayetteville, Arkansas, no relation between the two, and completely not intentional of jumping and meeting both of them, but it just so happens that both are very good markets to get into. So I just got off actually a pretty big webinar with a whole bunch of people right before I ran downstairs to go for a quick run. And I think there was like 50 or 60 people on a webinar I was just on. And one of the biggest questions is, what's exciting about the market? Why do you want to get into this market? What's good about this thing? And just admit all, hold on. We're going to open up the waiting room. Okay. One of the biggest questions is, why are we so excited in this market? And we are super excited about the Northwest Arkansas market, mainly because of, hold on. Sorry. Let me just turn this thing off. I definitely gave my phone number out to somebody that I definitely gave my phone number out to somebody that it just blows up my phone, because now I literally get phone calls all day long. Okay, let's get going. So I was just on a webinar. They were super excited. They wanted to know why we were super excited about the market. And really, the truth is a couple of reasons. We're buying irreplaceable real estate. We're buying real estate that cannot be replaced. We're buying real estate in a market that has about a 3% vacancy rate, which means there is no vacancy. The entire market is occupied, and any new product that comes to that market is going to be rented at a significantly higher price than what we're renting our apartments for. So right now, we're buying this. The summary here is we're buying a 56-unit apartment complex in Fayetteville, Arkansas, where the rents are on average about $750, $775 right now, with new leases being signed in the 900s. And all of the apartments surrounding it are being leased for over $1,000. So our plan is we're going to go into this apartment community that I'll show you pictures of in just here a few minutes. We're going to go into this apartment community, clean it up, change the landscaping, power wash the buildings, make them look nice. The current owner is actually the landscaper. He tried to get it so when we bought the complex, he would retain the contract. We didn't let that happen. It's one of the biggest problems with the units actually is that the landscaping is so terrible. When you pull up, it does not have the best appearance. The name is terrible, which we plan to change. Not to talk about all the negatives, but this is the stuff that we plan to change when we go in. And we want to see stuff like this. We want to see opportunity to make it much better without doing a tremendous amount of work. So those of you who know me know I have a strong construction background, strong renovation background. I'm basically scared of no project. I'll take anything on. But what winds up happening in apartment communities is we have competition when we buy these things, and usually it's competition that's better with or very good with numbers, but not so good with construction. So when we go in with a construction background and go to buy these complexes, our competition who goes in to buy them as well doesn't have the experience that I have, and they'll go in and say, I don't know, we could renovate this thing for $1 million, and I look at it and I say, we need at least 3 million to renovate this. They wind up wanting to pay more than we'll pay, and that's what happens with that kind of market. So the stuff that you'll see that we buy is typically power wash, landscaping, real simple stuff, pool furniture, and just broadly, I wouldn't say mismanaged, but undermanaged. The rents haven't been squeezed like they should have. Typically, the apartment complexes that we buy have been owned for a long period of time. So the current owner, at the basis that they get in at, they're making enough money, or what they think to be enough money, so it's not worth it for them to push. We go and push, we make the property make more money, and then all the investors get to share in that. So that's the highlight. I don't want to keep you guys all day. I know that this is the middle of a day and you're probably squeezing 20 minutes or a half hour out to see this thing. So we'll get right to it. I'll do a quick screen share. I'll show you some pictures. We're not going to get too deep into underwriting today. I leave underwriting for specific questions. Really what I'll do is I'm going to do a highline scan of the deck, of which you guys we could email it to any one of you. And just to highlight, you'll see some pictures. I encourage you to go on YouTube and check out the video of on-site. Alex and I were on-site. Alex, I, and actually Isaac, who's on the call. Thank you, Isaac, for joining. We're on-site. We walked through a bunch of units. We walked the whole site. I did a YouTube video. I showed you what we plan to do, what the unit looks like, what we want the unit to look like, and there's not going to be that much of a difference. Like I said, light value add. We go in, we change a couple things, we polish it, and we turn the dial up a little bit. I see a lot of people who get involved with real estate, and they want to be the next idea, the guy with the great big idea, and that's not what kind of investment you're getting involved with here. You're getting involved with apartment leasing in a market where we can't recreate, or no one could recreate the real estate that we're purchasing today. And why is that? Because construction expenses are just too expensive, and anything new that will be purchased, anything new that's going to be purchased has to rent for north of $1,600 or $1,700, and we're under that. So we will always be the affordable option. Alex, I'm going to turn my video off here for 1 second, just so I could pull up the deck. If you got anything to add to that, I'll be back in just a moment.
Sure. No, thanks everyone for joining. As Chris mentioned, we're definitely very eager to get into this market. We've been tracking it now for over 12 months. We've continued to focus on housing, and I think this market specifically has great fundamentals when it comes to housing. In one of our previous Zooms, we touched on where homes are pricing here. And I think, Arkansas being a new market for myself as well, we are pleasantly surprised with the home valuations here, as well as the amount of growth and wealth that's going into this market. So we've continued to be pleased with it. Vacancy is an all-time low within this market, and rent growth is outpacing most other markets you would look to invest in. Which is all part of our thesis in coming here. And we're very excited for this one and feel it'll be the first of many in a new market. And, as always, feel free to shoot any questions, notes in the chat. We're happy to clarify anything. We're happy to address a question on the spot in real time. So please use that as a tool, and we're happy to keep that as part of the conversation today.
Yeah, yeah, we love, love, love questions. There's nothing more, honestly, deep inside, there's nothing more I love than a live question. It helps me prove, it helps me prove that I know what we're talking about. I know what I'm talking about. Alex knows what he's talking about. We really love, like I said, live questions and not shy at all. This is literally what we do and talk about all day long. So, all right, good, got it. Okay, I got the deck here. Give me 1 second. All right, I'm back. I got the deck. Yeah, live questions. And I could tell you the biggest problem with these, the biggest problem with, oh, actually, so we're live on Instagram now too. There's a bunch of people there and I get questions. Why don't we move to Florida? That's a good question. Could I get a cash flow hat? Sure. That's actually from a current investor that, Vic, we love you. Thank you for being involved in all the deals you're involved with. This guy, he's actually, he was a past client where a lot of the investors of this company come from past clients. And the reason is when you work for people or do work on someone's house or build them a house, you're either building a great relationship or killing one. So that is an intimate relationship. Okay, so let's see if I can make this bigger. All right, Alex, you could see this, right?
Yep, we see it.
Okay, good. So here we go. Quick, 56 units, Class B. So Class B is your workforce housing. Workforce housing is typically units, Class B workforce housing is typically properties built like 1980 and newer in good areas with good working class people. So Class C and D would get worse and worse in neighborhoods. So we stay in good growing neighborhoods with good working class people. Everyone who lives in our complex or our communities have good working class jobs, which is exactly where I want to be. And so notice that I said that we're usually it's 1980s and newer. What really draws us towards this is it's 2001, built in 2001, which means the only problems that we will encounter in these assets are, or this asset as a whole, is the roofs, the parking lot, and the HVAC. Everything else is extremely easy to repair and take care of. So in Arkansas, most of the parking lots are concrete. Most places throughout the country, it's asphalt. Concrete parking lots last significantly longer. They're significantly more expensive to install, but they last significantly longer. So we're happy to get involved with that parking lot. As silly as that may sound, it could wind up being very expensive to replace. The roofs, so actually we were getting the asset with all new roofs with the exception of that red dot. They notified us the other day that that roof will not be replaced. So we said, we're not going to be interested in buying the deal unless that roof is replaced. And all of a sudden that roof is getting replaced before closing. So we are buying the asset with all new roofs, a great parking lot. And the only thing I see in the future as far as being a deferred maintenance issue are the air conditions that are on the side of the buildings. Again, very simple to replace, and we did account for it, which makes it no longer a problem. So 56 units, Class B, built in 2001. Like I said, it is 100% occupied. You can call the apartment community today, which actually I just came back from. Fody, thanks for jumping on. I just came back from Grant Cardone's office. We spent 2 days there presenting deals to him, and I was on stage talking with him about it. And he called the community live. So it's pretty funny that they didn't know that they were on the phone with Grant Cardone. Pretty interesting. He changed his last name so we didn't run into that issue. But he basically said, "Do you have any apartments available?" They're like, "No." Okay, what about next month? No. Following month, no. They said the furthest we could see out is August, and there's still nothing available. So it kind of proved to the point of this market being completely occupied, and we do not have any vacancies. And yeah, so that's it for that. $500,000. So we're putting almost $500,000 in the bank account for capital expenditures to take care of everything that I'm about to talk about. We do not see needing all of it, but we've definitely found that it's better to overraise and have that money ready for work that may have to be done. All of the returns that we're going to give you counts on us spending this money. Of course, if we go, we will put a marker on it, 1.5 years, 2 years, that if we do not spend any, or we don't see into the future of us, we don't see any of us needing, we don't see us needing this money in the future, we'll wind up drawing that down and doing a distribution to the members. So we do monthly distributions. So every month you'll get a distribution. We send it out on the 1st. You wind up getting it by the 4th or 5th. It goes out ACH. What we'll probably do is we'll do 13 distributions once we start a year. So we'll do 12, and the 13th will be a drawdown of the account, just so no money's sitting around doing nothing. It's better in your pocket than the deal's pocket. And every single month you get a copy of the bank statement. So every single month, TD Bank, you get the bank statement for the deal. So you'll see all transactions in and all transactions out. And these buildings, as busy as they may seem, it's actually fairly simple. It's all the rents come in and all the other income comes in, and the expenses go out, which is really probably a line item of 10 specific things. And you'll see it batched into one payment. We could give you further detail onto what that one payment was, but it's basically it's transactions in, transactions out, and we're left with the profit. Very simple business, kind of why we like getting into it, among other reasons. We're renting apartments to people who need them in markets that need it. We're raising about $2.5 million for this. That's what you guys are here for. We are over $1.5 million now. We had a bunch of commitments come in yesterday, so I'll check the portal later, but we are closer to the marker. So we're down to under $1 million needed, and we're closing towards the end of June. So from the 15th to the 30th, we'll close, depending on making sure that everyone comes in what they need to come with. If you ever close the deal, you know that you're usually close to the closing within a week or two. Okay, so this is basically it. I'm going to scan down to the photos just so at a high level you could see what we're looking to do. Right now, like I said, the rents are an average of about $775 across the whole portfolio. We are currently in control of all renewals. So when we sign the contract, we put in there that from going forward, you either do not renew the tenants or you consult with us prior to renewing them. So some people when I was presenting in front of Cardone, I brought that up, and a bunch of people who are actually in the business for a long time never thought about doing that. Remember, we have a business plan that takes time to complete. So when we close, we're already 2 months into that business plan. So really, when we close, we're going to have about $500,000 or $600,000 worth of equity in this deal that we created before we even purchased it. So now by the time we close, we only have 10 months left to finish our business plan, whereas we actually underwrote for 12. So it puts us and the numbers and the investors in a much better position with that simple line added to the contract. And remember, it's only about 6. It's up to date. It's about 6. By the time we close, it'll be about 12 leases. So it's not a tremendous amount of legwork for us to get this done. It's just one simple line that a lot of people don't think about, and saves us time. And time is money, as most of you know. So we're going to get into these things. We'll wind up changing the vinyl floors, painting the walls. We'll wind up changing the vinyl floors, painting the walls. Excuse me. And quite possibly, we'll test the cabinet painting and new hardware. I'm sure a lot of you guys have seen the TV shows of how much different the cabinets look with some fancy have $40 hardware on there. It will make a whole difference. So we'll see if it works, if it adds enough to the rent. If it doesn't, we'll wind up just not doing it. We will not over improve the units, and we will not renovate 100% of them. Our tactic pretty much is we're going to renovate as much as we can. Making sure that we maximize the value without completely squeezing, as crazy as this may sound, not completely squeezing all of the juice out of the deal, because then when we go to exit, it won't be as attractive to new buyers if there's no more juice to squeeze. So we won't renovate all of them. We'll wind up renovating half to 60% of them.
Yeah, Chris, let me address one question. If we go up to that
Yeah.
last page, we got a good question from Fody. The answer to that is yes. Each unit has in-unit washer and dryers, which we think is a huge benefit. Two-bedroom unit, typically more than one person in the household. We've seen that generate a lot of demand in the market. We've seen that assets that have in-unit washer and dryers just be an easier sell to tenants. So yes, we're super excited about that. And that is correct to Fody's question.
Yeah, that's great.
It's a great point as well.
Yeah.
Most people would overlook that. And you think about your own situation, it's obviously substantially easier when that's in your unit or in your building. Typically, if there's a laundry room, that's helpful, but the absolute best option is to offer that to a tenant in their specific unit.
All right, cool. We actually, it's funny. And the streaming of these live videos, it's interesting on the different platforms. And sorry for the people on Instagram. You can't hear what Alex is saying. You could only hear what I'm saying. So I'll get better at that. But you could always jump on the Zoom if you want because it's live. But if you like to just hear me talk, that's fine too. So this is a rendering of what the real high-end version of the apartment would be. We're not underwriting doing all of this because we don't think it's necessary. If we dabble and throw stainless in an apartment, maybe a backsplash, and we wind up outperforming what we say, then we would put our best foot forward and wind up doing renovations to that level. But usually these markets do not require that, and we don't get that far with it. As you guys know, and like I said, I'm not afraid of a renovation, but we're all here to make the most amount of money possible. And someone said to me once, is your only concern making the most amount of money possible? And the answer to that is yes. That's why we're here. And when I say make the most amount of money possible, it's for the deal. If the deal makes the most money possible, then everyone makes the most money possible. It's our number one focus. And actually not, like I said, not squeezing every single ounce out of it is also making the most money possible because it's enhancing the exit. So this is just, and not to get into deep budgets, you guys basically are hearing what we're looking to do. We're going in, we're doing some things, we're raising the rent, and that's how everyone's going to make money. This is more deeper underwriting. Again, I want you guys to ask the questions as far as the underwriting. If I start going through it, we'll lose a bunch of people and people will lose interest. So you guys want to know how much you're going to make over the course of the investment. I'll get to that. And the easiest part about the underwriting, and we put this in here for you and ourselves. So we know we're going to put all our expenses in, but we know market to market throughout the country where the operating expense ratios are for all the other apartment communities in the market. So we know Florida and Texas are more expensive to operate because the taxes are high and the insurance is extremely high right now. So Texas and Florida, you're going to see numbers like 49 and 50% to operate your apartment communities. Here in Arkansas, you're going to see closer to 30 to 35%. So we put these operating expense ratios in down at the bottom as our own gauge and for your gauge. If we're operating throughout the market, the same operating expenses that others are encountering, we're encountering. It's a good gauge to see that we're all in the right ballpark. So we really expect to operate this thing almost from the day that we take it over, or I should say, after operating it for 6 months, we should shoot it right down to 30 to 35% expense ratio. The reason that we level off at 36%, or it should be, we're really going to be at like 35%, is we spend more on property management than the typical operator would. And the reason we do that is we know that if we spend a little bit more on property management, that this number, so not the gross potential rent, vacancy, bad debt, it's a combination. Our net rental income number, if we spend more on good property management, this number will be higher. Why is that? Because a good property manager will keep this number down, will keep this number down, will keep this number down, and will keep this number down. So a good property manager will keep your loss to lease low, your vacancy low, your non-revenue units low, and your bad debt low. So non-revenue units, just so you guys know, that's a Alex, what do we call it? A community, what do we call it? Community.
We have actually a courtesy officer. So
Courtesy
here,
officer.
one thing that's, a huge value to this asset is we actually have a Fayetteville police officer live at the property. So not only does that have tenants, discouraged from anything criminal, but his police car sits in the parking lot, which just generally continues to drive away any negative sense of community, anything that could potentially harm the property. And, this has been a successful tactic that multifamily operators have been using for decades now. We will be using that and keeping that in place. We think it is an incredible value add that a lot of sponsors overlook to possibly generate a little bit more rental income. But we feel that it's very valuable to the in-place tenancy, new tenants, and obviously all of us as investors here. So that courtesy officer is something that a lot of people do not speak about, but will be offered here. And as Chris mentioned, property management is crucial. We actually interviewed 4 different property managers, throughout the market, groups that are credible, manage hundreds, if not thousands of units specifically here. And we landed with a group by the name of Elevation. They manage over 1,500 units in the market. We are happy to provide more clarity or their website. We're very eager to work with them. They have a very good outfit and, extreme amount of resources in the market. So we feel that the local management expertise will continue to guide us to success, specifically at this asset.
Yeah, I was just saying here that it's very common in markets that the police take their cars home. So here in New York and New Jersey, it's not very common. It's not common at all that they might have take-home cars, but they're not marked squad cars. So a lot of markets throughout the country, they're marked squad cars. So wherever the police live, there's a police car sitting wherever they live, and it's very common. And Alex and I take advantage of it. And it's not saying that we're in a market at all that we have crime or any trouble at all. It's just another added management tactic that adds to all these top lines. So people that live in apartment communities will tend to live in an apartment community that is safe or have a safer feel than one that doesn't. So again, this net rental income, it's all tactics that we use as operators to get that bottom line as high as possible. So sometimes it costs money to get that line higher, but the net effect is higher. That makes sense, right? It costs money to make money, essentially.
Yeah, if someone's also curious, if they've never lived somewhere with a courtesy officer, really the way they interact with our property manager is, every night they'll give a look into the parking lot, make sure there's no, broken down cars or group activity in the parking lot that's going on. So it truly is just another set of eyes. And, the feedback that we got when we were at the property is the tenants actually, they like it. They feel there's more protection. There's just more oversight. It's just a better sense of community. So, we're excited to keep this courtesy officer on and feel like it really is an enhanced value that not everyone takes advantage of. It also speaks to the quality of tenants here. Everyone is, a working professional. We have people here that work at hospitals, universities, within the municipalities, and obviously police officers. So, we feel like it's a very well-rounded, diverse tenant base as well.
Yeah, we drove around the market, and something very interesting to me. And Alex went to Villanova. I went to Baruch, so I didn't get to see this. Baruch is in Manhattan, Villanova being in Pennsylvania. We drove through the University of Arkansas, and the street looked like a movie. So the university is on one side of the street, which is absolutely tremendous. And again, I went to school in Manhattan, so it's just a high-rise building. And on the other side of the street was lined with these fraternity houses. And me never going to a school with frat houses or sorority houses, always thought that was they were like some just off the street beat up houses with kids hanging out of windows, and these houses were like built. It was straight out of a movie, just built with like the utmost detail. And Alex, who owns these? The sorority owns the house,
Yeah,
right?
yeah, the chapters do. And
The
the
chapter. It's
university,
very
yeah,
interesting.
the university is incredible. I mean, they continue to see increase in enrollment year over year. It's
Mhm.
actually an SEC school, so they're playing LSU, Alabama. They are a Division I sports program, which obviously continues to drive tax dollars, enrollment, out of state tuition. So the actual university is positioned extremely well. You can just Google, University of Arkansas, and very quickly see all the programs there. Brand new engineering school, brand new medical school. The Walton family continues to donate millions of dollars to the school. And typically a good school just continues to drive good jobs to the area.
That's right.
So we're excited about the university being nearby. We're about 15 minutes north of that, but it's just another great, demand and employment driver that, the property and the market will benefit from.
Yeah, so just to be clear, we are by the school, but we're not student housing at all. So who would be living in our units would be the employees of the school, not the students. So we are always interested in getting people who make money in our apartments, to say, I guess that's the best way to say it, but we're not focused on student housing. So I don't want anyone to think that we're by student housing and we're focusing on student housing, because we're not, when we mention the school. And then if anyone has a chance, look up the Alice Walton Medical School. They're building it now. It's amazing when you go there. First of all, it's a beautiful area. It has the most amount of mountain biking trails in the country. So it's a very active place. It's not, you go to Dallas and Houston. I mean, really, it's housing, food, drinks, and work. That's all there is to do there. There's not a tremendous amount going on, or at least what we've seen going to those other markets. This is a very active community, and the amount that the Waltons put into this area is tremendous. And remember, billionaires build towns, millionaires build buildings. So, and we're not talking, when we say billionaires, we're not talking about someone who made or is worth $1 billion. We're talking about families that are worth hundreds of billions of dollars. How do they invest their money? How do they multiply their money? There's nothing exciting to them anymore. So when you have hundreds of billions, you have to build and work up towns. It's no longer build and work up a building or buildings. So what we see here is, and another thing, and I was saying in the beginning of why we're so excited about this, is Alex has been on the phone with the mayor of Decatur, Alabama, basically telling us they will do anything we want to get us to go there and build hundreds of houses. They'll expedite paperwork. They will alter zoning, whatever we want. They will help us get there to build homes. And the reason is, in a market, in a lot of markets throughout the country, in order to get going, like the Nashville, all the big markets, Nashville, Raleigh, Charleston, Charlotte, all these big markets, in order for these markets to get started, they have to be seeded from an external force. And this market is being seeded by billionaire families. And when you jump on and join these families, everybody makes a ton of money. And when this neighborhood starts to take off like it is, then these families start to make an absolute tremendous amount of money because they're the ones that seeded the neighborhood. And that's why we're so excited about Northwest Arkansas. And there is no secret. If you want, check it out. Just Google separately, look at your own, check out the market of what Northwest Arkansas looks like. Excuse me.
Yeah,
And
no, we encourage that. Chris is making a great point. I think, truly just Google Northwest Arkansas growth and see the amount of publications that are going out. It's not a secret, and I think it's going to continue to pull. And Chris made a great point. You read about Charlotte and Austin. Those markets are great. They're having tons of tax dollars fuel into it. What's going on in this market is you have the wealthiest family in the entire country, really, really pushing money into the market. And that's something that, these cities' tax dollars just cannot compete with. So, we're pleased. There's 5 billionaire families just in this market alone. And that includes the Waltons behind Walmart, the Hunt family behind JB Hunt, the Tyson family behind Tyson's Foods, and the George family, who they made their wealth farming chicken for the Tyson Foods manufacturing plant. So there is a lot of wealth here, and these families continue to reinvest that money into their local city that they've developed this wealth in.
yeah, so we're excited, like Alex said, and I said, we're excited about the billions, hundreds of billions of money behind this area. Okay, so you know what? I'm gonna hit one more thing, and then I'm gonna go into how much money you're gonna make. But one more thing is just there's a lot of markets throughout the country that have seen an emotional drive up, an emotional drive vertical just during the COVID market. During the COVID time, or post-COVID, I should say. I hate talking about this virus, but it is what it is. So we pull up this exact chart of any market that we're entering, and we want to see what it's looked like since 2015, 2016. So before any of that was even mentioned, how did the market look? And you'll see a lot of markets, and I want you to go back to some of the most popular markets, and I want you to look during this timeline. So I want you to look from 2016 to 2020, or up until when this whole thing started. And you will see, including Florida, that line is straight. It's flat. I was looking at some houses, and my wife is constantly sending me these resort-looking homes in Florida. Who wouldn't, right? And the value of the houses were basically dead flat until COVID, and then they went vertical. So not a bad thing. Is it going to go back? I don't know. We don't know what's going to happen in Florida. It just continues to get hotter and hotter. But the point is that this market was increasing in value for as long back as 2016. What happens before then isn't really as important as the near term. Has been increasing in value since 2016. So it's another metric that we look at to make sure that we're not getting involved in a emotionally driven market, a market that's actually driven by a shortage of housing and an increase of jobs. Okay, so how much money are you going to make? The most important question and my favorite part. So this is our projected return on investment. And this is my absolute most page, and on most of our decks, it usually is page 18. For some reason, it works out like that. So this is what it looks like if you invest 100, 500, or $1 million. And it's basically the same, just multiplication is done. So year one, we're going to start distributions about month 8. A lot of people ask, why do you wait till month 8? And you know what? 2 reasons. The first reason is whenever you buy a business, which is what we're doing, we're buying a business. In my opinion, you shouldn't buy a business and start taking money out of the cash register the first month. Just my opinion and just the way we like to run. We're conservative. And remember, we are partners, 70-30 split. So whatever the deal brings in, we split. So if we're too conservative on our numbers here, which we probably are, that money's coming to you. But we estimate to start sending out distributions between approximately month 8. So year one, we'll see 4 months of distributions, which will total just about $2,000 on a $100,000 investment. Year two, about a $7,300 distribution. Again, because we started to uptick distributions, and we know that we own the property, so the property is chugging along. We're going to own it, and the revenue is going to go like this, and then goes like this. So we typically see this quick dip. Why? Because we get into the asset and we start ruffling some feathers. We go in, we do the cleanup, we do a whole bunch. We do, like I said, we do the power washing, the landscaping, and we start upticking the rents and start getting new people in. And just naturally, what winds up happening is human nature. A bunch of people get upset. Some people stay. Actually, more than we always underwrite stay. People renew their leases more than they wind up leaving because they look in the market. We still are going to be under what the surrounding apartments charge. So when people go online and they look at the Zillow, the apartments.com, first of all, let's call a spade a spade. Renters are friends with renters typically. So renters know that they're getting a good deal because they talk to other people about what their rent is, and they know they're getting a good deal. So when we raise the rent to market rate, which we're not looking to raise it over market rate, just to market rate, we will get some people to leave. Most people renew. They do a quick search of the area. They see there's no place else to go. This is all stuff that we do before we buy it. We call local apartment communities. We visit them. This is all part of our due diligence, some of which you could see on the YouTube video. And so we see that quick dip, and then it goes off, and the business plan is starting to get executed. So that's perfectly representative of what we see here. So like I said, year one, year two, and between years 2 and 3, so between months 24 and 36, we will refinance. We're betting that rates go up, continue to rise, and stay there. So that's what we're underwriting. If rates stay flat or continue to come down, this number will be higher. So our goal on this deal is to return 100% of member capital by month 36, or between months 24 and 36. So our goal here is to return all of your money by year 3. So you can now take that money, reinvest it into our deal, another deal, your own deal, and have that money now working for you twice in 2 separate deals. And that's when investing in real estate really starts to take off. So a lot of people, we've seen a lot of people who, or a lot of investors who don't get into real estate, and it's because they want to see what happens year 1. And it's just not a fair way of looking at it. Real estate is kind of the slower game to true wealth, as opposed to the quick money route, which we've seen a lot of people who don't do it or aren't impressed with year 1 wind up putting their money in the stock market, and by year 3, that 100,000 is now worth 40,000. See it all the time. A good friend of mine, I was just on the phone with him yesterday, was putting money into this deal, keeps crying about his crypto account. Listen, we don't have any control of that. There's no way to predict the future. There's no way to predict the future of the stock market. Whatever company you're investing in, there's no way to say, will Amazon be in business forever? Historically, no. I mean, whoever thought Sears would go out of business? They were a monster. Whoever thought Macy's would go out of business? So the future of these companies is strong, but still questionable, where the future of housing is undeniable. There will be a need for housing. I bet for as long as anyone that's on this call will be alive. So we're just betting on the need for people to live affordably, and that's what this investment is based off of. So,
hey, Chris, can I ask a quick question?
Yeah,
on
go for it, bud. Absolutely.
I was just trying to figure out how kind of like sponsor fees and carry factor into this projected return on investment chart here. Are these figures all what are expected to be returned to the LPs, or is this calculated after carry is taken and after like the acquisition fee and ongoing fees are taken?
Yeah, that's a great question. I'm glad you asked that, because I'm sure a lot of people wonder it. Like, are these the net to my pocket? These figures are the net to your pocket. So this is after everything has been paid. So this is completely at the bottom of the line. This is net. This is what you will see ACH to your bank account.
Yep. And Andrew, I will also note here that we're expecting to return all of that capital, call it month 26 of the investment, just over 2 years. We've taken an extremely conservative view. We're happy to speak on that offline, but we're assuming that rates have actually gotten higher than they are today at the time of refinance. And obviously our conservative underwriting with, higher expenses, higher occupancy, we should be able to, as we have on prior investments, repatriate more than 100% of the capital. We just, that's all market dependent. I will, firmly say we take a more conservative view to that refinance than almost any other sponsor you're going to work with. Even on our exit, we're projecting that 575 exit cap rate. This arguably would trade south of that today. In a short glimpse backwards, assets like this were trading at a sub 5% cap rate about a year ago. So, we actually think that we can under promise and over deliver on these returns that we're sharing here.
Yeah, that's all a great point. And Alex and I, we always, when we do these underwriting models, it's constant. We're constantly pulling back what we expect, just because we'd like to be the champs at the end of the day and over deliver on what we're saying. So basically, part of the worst case scenario here, I wouldn't say worst case scenario, absolute conservative approach. You're doubling your money in 6 years and you're getting your capital back by year 3, very conservatively.
Yeah.
Good.
No, it's a great point. And, honestly, we very much encourage you to reach out on our prior investments where we've put together the same materials. Now we're live operating the deal alongside our property managers and our management team. And we are outperforming these similar decks that we have put together. So if you wanted feedback on some of the more recent acquisitions, we're happy to share that, just to get a general feel for how we looked at things going into the deal and how they've positively fleshed out, over the last 6 to 18 months.
Yeah, absolutely. Showing what we have and how it's doing. We got some numbers on an asset that we purchased in November yesterday, and it's tearing it up in the most proper way possible. It's kicking ass. And usually, like I said before, really 5 months, 4 to 5 months after we acquire an asset is the real time to start looking at the numbers, which is right now for that asset. And it's ripping. Like I said, we buy it, it goes like this and then comes up. And that's our work. That dip right there is us coming into town, which is a good thing. We're there to shake the tree. When you buy a business, you go in, you wait a couple weeks, then you shake the tree, and then you get back to it. One of our favorite parts of acquiring the assets. Because really, quite honestly, once we squeeze it and once we get it going, so call it after 12 months, the work is mainly pushed through by then. And then it's steady cruising and everyone's getting their cash flow and cruising along. The calls get significantly easier after 12 months.
Yeah. Fatih, you asked a question here. We've done a few full cycle deals. Chris could speak to everything that he's built and disposed of. We've done a purchase in Huntsville where we bought a property for $3 million. We then refinanced it for $5.5 million just 12 months later. A deal that we bought in December of 2021, we bought it at a going in mid-3s cap. We are now stabilizing north of 7.5. We have fixed rate debt there. So, we've very actively acquired deals and seen them outperform, from a market standpoint, and we're positioned very well. I think one of the reasons why we've been able to look and have all these deals that are on Chris's screen right in front of you since just November of last year is because our conservative underwriting and the way we look at deals. We've borrowed fixed rate debt on every single transaction that we've done, and that's given us a lot of stability and a lot of predictability on these deals, which is a benefit to us and our investors. You don't have to worry about in 2 months, what does the Fed do? What happens to mortgage rates? We are completely hedged there. So I think that speaks to the success that's to come and the reason why we're able to buy a deal when multifamily trades are just significantly down from where they've been the last decade. You know, we're happy to elaborate on any of the underlying mentions or economics to these three deals on the screen.
And just so everyone knows, everyone on the call, and again, thanks for jumping on. We'll leave the rest for questions because we know that this is the middle of your day. This investment is for accredited investors only. So accredited investors is single, you make over $200,000 a year. Married, you make over $300,000 a year, or your net worth is over $1 million outside of your primary residence. And the good thing with that is your pension or your retirement savings, your 401 will count towards your net worth. So if you own something on the side and then you got some money in a retirement account, a lot of times people are accredited and they don't know it. And a lot of times people, they are accredited and they think they are and they're not. So it's one of those great, listen, this is one of those things that when you become accredited, you make a couple extra bucks, new opportunities open up to you. This is one of them. You're allowed to get into a large scale real estate at a smaller percentage, as opposed to trying to go find your own deal, managing 2 apartments. There is literally no difference between this and that. You could go find your own building, rent 2, 3, 4 apartments, deal with that, go through everything you have to go through. And there's a very good shot that this would make the same or close to, if not more money than that would. And remember, you're a direct owner of this asset. You are on the operating agreement. So technically you are a deed holder. So you do get to take advantage of the depreciation of the asset, which if you could take advantage of it, usually you could take advantage of it. But we're going to do a cost segregation study here, which allows us to depreciate the asset very rapidly in the first year of ownership. And we could only speak on what happened with 2022 because 2023 is a new year. But in 2022, our investors got back 63% of what they invested in a deduction that year. So we had one investor who invested $800,000 in the last deal. He got a deduction for $500,000, and his wife was a real estate professional, so he got to deduct $500,000 off of taxes that were due that year. So this is in addition to everything else we spoke about. The tax deductions on these are serious, and when you hear people like Cardone or Trump, I know they're not in the same class, but these guys that don't pay any taxes, the big real estate guys that don't pay any taxes, part of it is the depreciation of the assets they own offset the taxes that they make, and it allows us to operate in a near tax-free environment. And you get to take advantage of that. Last year, we sent our K1s to our investors, and they got into the investment knowing what the returns were and counting on those, completely not accounting for the depreciation and the tax benefits that they'll get from this investment. And it caught some people off guard, which is another favorite part of me doing this, is when people get involved with something that we're doing, get a benefit that they didn't know about, and it catches them off guard. It's a rewarding thing for us. So yeah, let's hear some questions, because I've spoke a bunch. You heard me speak, you heard Alex speak. We told you about the asset, what it looks like financially. If you have any questions, jump on. So Fody, yep, we got self-directed IRA, all in, no problem. We're looking for LP capital. So the GP's taken care of. Alex and I love to run these assets. We have the net worth and liquidity necessary to get them closed. And we do, so just so you know, and this is getting a little bit more technical, but when you hear actually the same day or the day after, Alex, I think it might have actually been the same day that the Fed announced the rate hike, the 25 basis point rate hike, our interest rate actually went down. And the reason is every loan is based off of a different index in the market. So our loans are based upon the 5-year treasury. So based upon what the 5-year treasury does is the interest rate of our loan. So when the Fed announced a 25%, but 25 basis point hike, that did not affect the 5-year treasury negatively. It affected it positively, and the two probably had nothing to do with one another. But the 5-year Treasury goes down, our interest rate goes down, and because of that, we got an extra year of fixed term, which we have 5-year fixed term. Originally, they proposed a 4-year fixed term for us, and because of the 5-year Treasury dropping, they increased our term to 5 years. So when you hear the Fed hiking the rates, it's not a direct correlation to what we're paying for the money. And just so everyone knows, we're paying 6% for the money. Go ahead, Alex.
Yep. No, those are great points. Yeah, as I mentioned, a fixed rate interest rate. Jacob asked a good question. Besides the 70-30 split, what other fees is the sponsor taking, and how does a refi work? So we will be taking an acquisition fee. And again, as far as the refi, the investor will be getting 100% of their own capital back before we start to see any distribution. The way I explain it to anyone who invests alongside us is the only way that we actually make money is if the investor does. We only share in the performance, and that is why we are incentivized to work on this deal 7 days a week, 365 days a year. The only way that we see the upside is as the investor makes money. If the deal was to make 8%, we would not be making any money. So for us, we're truly incentivized to perform. Once that refinance happens and the investors return their capital, that is where the shared economics will come into place. So that is correct, Jacob. The sponsor will receive no distribution until your 6% preferred return is returned back to you. So it's a long story, to summarize that, it's a 6% pref on this deal.
Yeah, we get nothing until the deal hits 6%. And to note, it's a cumulative pref. So it's accumulating from day one. So year one, if you invest $100,000, the deal technically owes you $6,000. And that goes on to year two. And then year three, year four, all the way to the end. So at a bare minimum, the deal is accruing 6% owed to the investor every year. So it's a cumulative preferred return. Yeah, so it's basically, the sponsors do not make $1 above our acquisition fee and our asset management fee unless the deal returns north of 6%. And our asset management fee is basically our asset management fee is to manage the property manager.
Yep, and the asset management fee comes, post positive NOI and performance for the investors. So, we'll be, sharing live financials monthly. We'll be comparing our budget to our actuals. One thing that we pride ourselves on is full transparency. So anytime you have a question, you reach out, you're getting a direct answer. It's us who will be answering the question. There is no, barrier. There's no, we give out our cell phones. It's, we are happy to opine on any information that you need throughout the investment.
Yeah, if an investor calls me, I start to sweat if I missed it. That's how urgent it is for me to get back. And anyone who's invested with me could vouch for that. And I know we have a bunch of investors on the Instagram. I don't know if we have any.
I think but Andrew may have invested alongside us. But if you would need a reference, we're happy to provide. We've had repeat investors. We're excited. We're excited to grow our network here, and definitely excited to be in this market.
Yeah, so if anyone has any other questions, we'd be happy to answer them online or offline. We have no problem answering questions in front of everybody because everybody learns. If you have a private question, by all means, jump on it. And also, I don't know if I mentioned on this call, I know I did the webinars tend to start to migrate into one another, but we send out the bank statement. I think I mentioned that on this one, right, Alex? We send out the bank statement to the deal every month. So you see the exact transactions. You'll see the distributions go out. You see everything. That's a testament to Alex saying that we're fully transparent. It's your deal. We're just running it.
Yeah, and if you'd like to see an example of one of these reports that you'll receive after you invest, just let us know. We're happy to share that. And to Steven's last question, is it easy to evict in Northwest Arkansas? Yes, it is a landlord-friendly state. 7 days of not paying by a tenant, you are able to file on them. So yes, we are not investing in California or New York where that's a difficulty. It is a very landlord friendly state, which we believe will bode well for this investment and the future of this market. You read a lot about Blackstone, Brookfield. They're continuing to deploy in landlord friendly states for that reason. So we're just really here getting our piece of the pie and leveraging that thesis as well.
Yeah. Yeah, all great points. Like I said, any other questions? Hit it. Now's the time. If that's it, I think we could wrap this up. I think we hit everything. And you know what? Oh yeah, a quick hit on what Alex just said, or the question that came in Northwest Arkansas. So my investment career started in New York. So I basically started in the absolute worst market that exists. I should say one of them. There are similarly terrible markets. I actually think California might be worse, but I will never get any investor capital involved in a deal that we are unable to operate our business the way it should be operated. So this is the reason why we go to these states that are landlord friendly. And it's not a bad thing towards tenants. It just allows us to operate our business. So, if you don't pay your rent, do you get ripped out of your apartment in 15 minutes? No, they give you a fair amount of time. And it's usually fully encompassing of a month or a month and a half. And that's what it should be. We could get into this deep topic all day, but any other business you get involved with, if someone steals from you, there's going to be some action right there. For some reason, there's a bunch of states in the nation that don't agree with that with housing. But if you pay your rent, we're some of the best people to lease from. Our apartment communities remain very well kept and beautiful. And if you don't pay your rent, you got to go somewhere else. So it's as simple as that. And we operate our business very, very tightly. We do not extend the rope to any stories that may be coming through the door. And that's because we are a steward of your capital and our own capital. And we make sure that we're operating a very tightly ran business. And that's our main focus. So, and we go to states that allow us to do so. So it's very important that we're in a state like Arkansas or Alabama or North Carolina, the three other main states that we own assets in. And then you got Georgia and Florida and some other states that are very good, Texas. But these are the markets but basically that Southeast market is the most densest place where the states exist that businesses ran like that. And you know what? What's interesting, and not to get too deeply into this, but markets that operate tightly like that, you don't see like rampant homelessness or, now we're getting political, but, you don't see the problems that you may think going, running a business tightly like that. You don't see the problems don't exist there as much as you may think. I mean, it's all very clean. The areas are just wonderful. Great places to live.
Yeah. And we got one other question, Chris. Yeah. Are the sponsors putting any money in the deal? Right. As of now, we do not intend to. We happily have, and if it calls for it, we will. I will say, as a point to that, Chris and I are putting our own names on this loan. We are giving, our full financial picture. We are on the hook for any bad boy carve outs. So, we're going to be in this business and we have existing deals. We are signing on this loan in order for the deal to make money and our investors make money. So I do feel like that is, in my opinion, a stronger incentive than my own 100,000 into this transaction. We would, we very much would, and I think it'll come down to how the capital raise fleshes out. as Chris mentions, we're on the tail end of it, but just wanted to address that question and a little bit of how I would look at it.
Yeah, just so you know, and me personally, Christopher Stout is out about 200,000. I have about 200,000 into this deal before we even close it. Currently, 200,000 of my money is out on the deal. And that's comprised of lender deposit, earnest money deposit, and all the fees and expenses that go with closing it. So really, when it comes time to close the deal, depending on what the need for the investors determines if I leave the money in or not. And basically zero for me is $1 million. So I basically have to stay liquid for somewhere in the neighborhood of $1 million just to put the next deal. So all the risk is front end loaded. All the risk is front end loaded on us. Once the deal is acquired and operating, that's when the risk dwindles. So, and like Alex said, we sign on the loan. So, it's easy to say, yeah, absolutely, we're going to throw money in, but it's usually a moving target. A lot of times we get, we do these webinars, we announce to the investors and the investors rush in. And, it would almost be selfish at us at that point to say, no, we're taking that $100,000 or $200,000 spot for ourselves because we signed on the debt. So for this deal, $3.5 million of my net worth is on the line. So, that's a common question. If we put money into the deal, we have a lot on the line to start. So the 100 or 200 that we put in, like I said, it may, or depending on how it happens, it may or may not happen. And everything that we say, our answers are transparent as possible. So it's easy to just beat around the bush and answer it differently, but that's always how it goes.
Yeah. And, one other question, will that 200,000 be reimbursed? It will, but I will say, in order for us to tie this deal up at this attractive price, we actually gave a hard money deposit. So that money, if something had come up, that's our money at risk, no one else's. But, we feel like we're incentivized to do that, to lock in this acquisition at a very attractive price for everyone. And, as most of you, people on this call can resonate with, if someone was to, come with an offer to buy even their individual home, someone that's committing money day one, that's an attractive offer. And that's kind of been the way that we've been able to tie up deals and continue to drive certainty to the sellers. So as of today, that money is at risk, and that's fully on us acquiring the deal.
Yeah, and just so everyone who isn't aware, hard money means the money is completely non-refundable. Unless there's some level of fraud on their side, if we change our mind or can't close the deal, they keep that money. And you know what? I love doing it. I love doing the hard money. It's exciting. I'm so confident in these deals. By the time we actually wire that money out, or we sign the LOI and we get our numbers across, we know we're closing that deal. That deal is happening with or without the investors. I'll stroke the whole check if I have to. And it's interesting to hear the reaction when you're like, hey, we're going to do this and we'll wire the money today. You want 100, 200, you want 500? Sure, we'll wire it. And that gets people moving. I mean, I know that there were people, we were competing with other buyers on this deal. And the reason they went with us was that hard money clause. So there, I don't know this to be true, but there would be a small percentage of people who would say, well, hopefully something goes wrong with Stout Cap, so we could just keep that money and go to the next buyer. But essentially, that's what could happen. If we don't perform, they keep our money. All right, guys. Yeah, I think that's it. Like I said, reach out. You could email me, Chris at Stoutcap. I'll put it in the chat for now. Chris at Stoutcap. And I like to pride myself as the fastest email answer on the East Coast. I'm close to it. Yeah, so email me if you have any questions. We'd love to see you guys in the deal. Jump in the deal. We will never let you down. These deals are rock solid, and we love to be a part of them. like I said, simple business, renting apartments in areas that need them, collecting rent and doing distributions. That's the long and short of this whole thing. So, all right, guys, thanks for jumping on, and we will see you soon. Bye.